looking at the half-year results of Capitec, and the summary first, starting with the macro environment. So we've seen some pressures starting to emerge on consumers' credit health, although them still being at quite healthy levels. It's just a deteriorating trend now starting to emerge that we'll just keep an eye out going forward. On a valuation perspective, Capitec has been trading at a premium compared to its own price history and compared to peers. But in September, the share price came down a bit with the releasing of its results. So those valuations are starting to become a bit more attractive for the company being such a growth and profitable company, that being included. So looking at the most recent results, Capitec still showed growth. It had excellent cost management, but this was held back a bit by the impairments normalizing, as they provided now more on a normal basis compared to the prior year. The provisions for impairments was released to the income statement. Overall, the headline earnings was up 17% and it achieved a return on equity of 26%. Declared a dividend of 14 rands per share, and operating profit before provisions was up 24%. Then we have a hold recommendation on Capitec, and that's due to its valuation multiples being at a premium. Looking at the net income, it was able to increase its net lending, investment income, and insurance income by 15%. This at the back of the insurance, credit insurance side, which is a small portion, but it grew by 60%. That on the back of lower claims, increased premiums, and active book growth. Net interest income was up by 11%, and that's basically due to gross loan and advances increasing by 18%. The rise in repo rate also helped with interest income on loans increasing by 13% and interest income on investment up by 31%. But on interest expense side, it was also up 33%. Net transaction income, which is the largest non-interest revenue item, increased by 8%. This due to Capitec still achieving client-based growth and product expansion. On a, let's say, more negative side, the income was up 16%, but the expenses on 38%. So management mentioned that this is due to clients shifting to more cost-effective transactions, and they defended further that when clients shift to more cost-effective transactions, these transactions are more scalable. So while that would increase your expenses at a rate high of income is due to these cost-effective transactions earning them lower revenue. Further, they also mentioned that the reasons being they didn't increase their digital fees, I think, in the last 4 years. They had abnormal rebates in the prior year, and they also launched their Live Better rewards in the current year.
Thank you very much for joining us today.